Well, good afternoon. This is Chris Robinson, Robinson Ag Marketing with today's post-close screen and last comments for Wednesday, the 5th, November. Well, pretty interesting story. The Probably the most interesting theory is that I actually kind of starting to line up with a little bit is that the Chinese actually may not be buying physical grain. They may just be getting long futures. That would explain why we continue to push higher here in the contracts after a little bit of a dip. There's no evidence with the people that monitor the cash markets that they've done anything in the cash markets, right? So they're not booking things with through the PMW or anything like that. So this may be how they're getting around it. I kind of would tend to agree with this. There's nothing definite yet, but if you look at the jump in the open interest in the last week or so, that could be what they're doing. So that may be how they're going to meet their quote unquote obligation. They did buy about 500,000 metric tons of wheat. Some people say it's less than that, maybe 250,000 metric tons. Again, I think that was more of a courtesy booking than anything else. In reality, they just bought more soybeans from Brazil. Why wouldn't they? It's $2 cheaper down there. The basis down in Brazil has really dropped. So I think in order for them to um, meet their obligation, it's somewhere around 88,000 futures that they have to buy, which if you look right now, the funds are long about 100,000. That's managed money. That's wouldn't be that crazy to see a big long position there um, built up. So at the end of the day, I don't really care why this is happening. People can dig into the why or the how or the who or the what. It's a 16-month high. If you're a producer, this is what you want. A month ago, people were on TV, um, I guess the word I would use is morose, right? Just and of course uh, politics being what it is in this country, there are certain people that were just, they were reporting on it, but they were pretty happy about it. How's that? So now to see us at 16-month highs with over $1 rally of beans, don't worry about the why. This could have been any reason at all. If it's the Chinese buying futures, so be it. At some point, they're going to stop. At some point, we're going to have a correction. And we all know what corrections look like. If you don't know what a correction looks like, go look at the cattle market. Okay, we rallied for 10 months, and then in a month and a half, we lose 50% of it. So don't worry about how high it's going to go. If you're a producer, what you want to do is make sure that you don't get caught holding the bag, literally, when the party's over. If you look at fat cattle, I can't, stress that enough. I'm looking at a chart right now of live cattle, fat cattle. We've people kept waiting for the when is fat cattle going to come down? Well, it's happening right now. If you look at the February contract, which I'm not looking at right now, I'm eyeballing it. The low last year, 174. The high on this contract move was 250 and change. What's so significant about where we are today? Well, 220, 221. That's a 38% retracement of that whole thing. If you follow me, you know that I pay attention to the Fibonacci's, not because they are perfect, but because they do attract um, business. Both buyers and sellers show up to fight over those levels. You have to remember my background. I stood in the pit for 18, 19 years with people. They would just as soon stab you in the face with a pencil as to talk to you. Sometimes, and they got very, very competitive. At the end of the day, people buy and people sell for whatever reasons. Sometimes, it's just their gut feel. Sometimes it's their plan. Sometimes it's because their charts tell them. I've been doing this long enough to know that these levels, for whatever reason, attract business. So that's why we look at them. And lo and behold, we're under here at this 221 level today. In fact, cattle settled down at 218 under pressure. What's the next big level? You don't have to be a rocket scientist. If you want to know, any charting program will tell you this. The halfway back move is somewhere down around 212. That's the entire year. So what took 10 months to create in the space of since October 16th, this is November 5th. All right. So in 3 weeks, what took a whole year, we've given back 40% of it in the matter of 3 weeks. So that is why we hedge. Nobody got a special text message that the top was in because trust me, I was working with guys who were short futures the whole way up as hedges. It was very, very difficult. Some guys were short futures, some guys were rolling puts up. But at the end of the day, I think that the people that rolled the puts up are probably in a better situation because every time it went up $6 or $7, we spent a dollar. If you were short futures, you were just making margin calls for the whole way up. Feeder cattle down limit as well. March finished down 925. Tomorrow we're going to have expanded limits, a little over $13 tomorrow. Will that happen? I don't know. We could get expanded limits and go higher. We've seen that before. But the math problem there is the same too. If you look at the overall big move, and I'm looking at March futures right now, this started at 268, 270 in April, not that long ago. We've now given back over half of it. So April, May, June, July, August, September, 5 months to go up from 268 to 378, and then literally in 3 weeks, we've given back more than half. And now the next level below. And if you want these levels, like I said, call me up, give me your email, send me an email. I'll sign you up for my letter. I do this stuff every day. They do them homework every day. If you're looking for support, I would look down at the next level on the retracements, which is a 62% retracement of that entire 1 year move. That's down around 311, 310. And again, at some point, we're going to turn around, and then probably when all the people who didn't want to hedge higher, when everybody calls up and says, hedge me now, that's probably where we'll bottom out, because that's human nature. Every market does that. I don't care if it's the real estate market, the stock market, whatever. When people get to the point where finally they're like, "Huh, maybe I should have hedged instead of looking for the next high." That's generally how we put a low in. We just saw that with wheat. Wheat hit a 5-year low after a pretty significant 2-year sell-off, $2 break. Now wheat's managed to claw back about 25% of that on a 50-cent bounce. Is there more to come? Possibly. I've got that chart in my letter as well. There's potentially some upside there if it keeps going. And we need a confluence. It's a big SAT word, which just means you need a bunch of things coming together like a perfect storm. You need weather. You need demand. You probably need a little bit more short covering from the funds. And I'm going to talk about that real quick too. The funds, what are they? They're long 100,000 beans. They are short 80,000 or 70,000 corn, 70,000 wheat, 70,000 meal. Those are the positions that I would watch. What are they going to do as DEES goes into March? Are they going to stay short their DEES position, or are they going to cover their DEES and buy more March? I don't know. That's going to be something to watch as DEES March, moves along here. Right now, DEES March, that spread's about 13 cents. I would watch that. If you look at March, May is about 9 cents. May, July is about 8 cents. So watch those spreads. They can sometimes be a tip off as to what's going on. But I think the biggest story today is the fact that the Chinese possibly are just going to cover their obligations to quote unquote be long soybeans by buying at the futures market. At the end of the day, they can always take delivery of it next year when they want to. So pretty interesting thing. I think a lot of people, including myself, didn't think that was going to be an issue. Generally, we thought they were just going to, call up the elevators around the country with the Sino grain people and say, hey, we want to book some beans. I think this is the way they did it. So I've been doing this for 3 decades now. Learn something new every day. Again, there's no confirmation of this, but it's the prevailing theory out there right now from a lot of quote unquote experts. And so I'm just sharing that with you. So that's it for the day. What are the net changes real quick? DEES corn, 435 and a quarter, up 3 3/4 cents. If you're working with me, we're watching. If we get a little bit higher here, we're going to move some corn. November beans, they're in delivery, but they traded as high as 11.20. We're looking at jam beans, hit a high of 11.37. That, kids, is a new high for the move. Remember, we had a couple days, then we had the sharp sell-off. We've come back now. I think that might be, again, sort of buy the rumor, sell the fact. Obviously, people are getting a long position on here, either on paper or on somewhere other. So what's the next old high? I'll have that in my letter tonight. I'll have the retracements tonight. Any way you cut it, it's been a tremendous rally. If you go back to look, I'm looking at jam beans, the low in August, $10. So here we are at 11.34. So that August low, that terrible trade, we traded $10. So we're $1.30 higher. What's the $1.30 worth to you? If you go back to even October 1st, we were at 10.12. So, that was a pretty dicey moment, October 1st. October print, I remember that very, very. A lot of people were like, "Oh no, here we go. Here comes $9 beans." So this is why we hedge. This is why when we were down there on our lows, we didn't have more than 10, 12 cents into a soybean put because we were hoping for a rally like this. You didn't want to have a 30-cent put on when you're on the bottom because who wants to lose 30 cents on a rally? I was happy to lose 10 cents. Um, that's great. You lose 10 cents on the put that we had tied up and you picked up $1.20. I think that if I could promise you every time I spent 10 cents on a put, the cash market would rally $1.20, you'd be calling me every day, buy me another put, right? We just keep going higher and higher and higher. Buy the put, we rally $1.20. It's awesome. So that's the way a hedge is supposed to work, honestly. You had your protection in case we did fall out of bed down there. And that's right around the time that the news stations and everybody were running the stories, walking through the field with the soybean farmer during the news, saying, "Oh, woe is me." And then when everybody gets bearish, when the whole world is bearish, 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 we turn. So just file that away for future. The same thing happens when everybody gets bullish, bullish, bullish. At some point, this soybean market, they're going to be on. It's going to be in the cover of Time magazine saying, "Oh, soybeans, that's probably going to be the top." So stay awake, stay frosty, pay attention to what's going on. I know it's difficult. There's a lot of hours. There's only so many hours in the day. If you're looking for help, if you want to sort of subcontract out your marketing and your market analysis to somebody, there's a dozen people out there like me. I certainly did not reinvent the wheel. You have to find somebody that you like and you trust to work with. That's what I would tell you. But you need to have a structured approach to managing risk. This is Chris Robinson, Robinson Ag Marketing. Have a great rest of the day. Give me a call, 312-638-8868. I am going to be posting my private client seminar tonight. I'm doing it. I'm going to spend about an hour and a half on it, post it. It'll be a little mini classroom as to what we're looking at here. Lots to talk about. I'll dig deeper into these levels and what we're looking at, what we're doing. I have made cash sell recommendations and also hedge recommendations for new crop soybeans. When a market gives you 16, 17-month highs, you can't be asleep at the wheel. You need to reward it. And I will say this, setting a hedge or making a cash sale is not somebody taking their shirt off and pounding their chest like Tarzan saying, "This is the high." Absolutely not. What it is, it's a good business decision. You're managing risk. You're not calling a top. Again, and my background was I stood in the pit with a bunch of people that screaming and yelling, and again, would have pushed you in front of the train just as soon as helped you in front of the train, depending on what they needed at the time. Very, very competitive. When the markets were going on, there were no quote unquote friends. When the market was over, it was a different story. But during the market, it's dog eat dog. So you've got to take what they're giving you. And if you stand there and stew about why is this happening, what this, that, those are the people that get run over. So any way you cut it, this is a gift. I want to take advantage of it. I hope we keep going higher. If you're a farmer, producer, you're always bullish, right? Don't worry about how high we're going to go. It's what are you going to do if you lose a bunch of revenue? And the best thing I can wrap up with this is exactly what's happened with cattle. Tremendous revenue gains in the last year. And then here in literally 3 weeks, you give back half of the entire 10-month rally in 3 weeks. That's why we hedge. Have a good day.